Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is Andrew Beer, Managing Member at Dynamic Beta Investments. They offer some hedge fund-like strategies in very cost-effective, transparent, and liquid wrappers, including two ETFs, which have done very well this year. Their managed futures ETF is up more than 30%, and the long-short hedge fund ETF has also significantly outperformed the broader indexes in this very, very challenging year for the market. Andrew, welcome. Great to have you on the show.
Well, thank you so much, Neena. It's great to be here today.
So you are joining us on this show for the first time. So I wanted to start with your background. And I, in fact, looked at your bio, and you have a fascinating, very interesting background. So tell us about your background and your journey in the investment management industry.
Sure. So thank you for asking. So I've actually been in the hedge fund industry since 1994. So I joined the industry when it was very much of a cottage industry. Before that, I had worked as an investment banker, and then I'd gone back to business school. And I think I thought I was going to be a private equity guy. That was kind of the cool thing to think about doing back in the early 1990s. I had absolutely no idea what a hedge fund was, but got basically tapped by one of my professors at business school to meet a guy named Seth Klarman, who's a very well-known hedge fund manager. And Seth interviewed me, some of his partners interviewed me, and I kind of sort of fell in love with what they were doing, which was to find interesting, off-the-run, idiosyncratic ways to make money. And so I'm a little bit unusual in the hedge fund world in that I've started businesses in different areas after I left Baupost. So I've started businesses in the commodity space, also in the Greater China region. But really, my true passion over the past 15 years has been a singular focus on, if I'm an investor who cares about liquidity and who cares about fees and doesn't want to blow up risk and all the sort of things that make investing in hedge funds difficult, how can I do that in a vehicle like an ETF or a mutual fund or a UCITS fund? So the ETFs that we launched are really a culmination, even though they're both 3 or 4 years old. It's a culmination of 15 years of work of trying to solve that issue, and the ETFs are the means by which we can deliver those to a broader segment of the investment world.
So you mentioned working with Seth Klarman. He's a legend, value investing legend, and his book, Margin of Safety, is a rare classic. So tell us what it was like working with a legend like Seth Klarman. Do you still get to meet him or talk to him?
I haven't seen him in a number of years. I think, when I went into the hedge fund industry, I didn't really know what the hedge fund industry was. And I think in some ways working for Seth, it was an incredible opportunity because I was able to walk into the office and the only mandate was to try to find interesting ways to make money. And Seth is extraordinarily smart, and I learned an enormous amount, not just about what to do, but also what not to do. And I think he has incredible restraint as an investor. He's his priority is don't lose money. His priority is, unless you have a great idea, don't do it. And that that's been a big influence on the rest of my career, where I've made a series of very, very, very targeted, carefully calibrated bets on certain big trends that I thought I had an edge in analyzing, and to be very, very careful about not wasting my time on bets where I had a 51% chance of being right.
Excellent. So staying on the value investing theme for a minute, we know that value stocks have been outperforming growth stocks, and growth stocks had delivered very, very impressive performance for almost a decade. But this year, In particular, these stocks are struggling as interest rates rise and inflation stays at elevated levels. So I was interested in your thoughts on the outlook for value versus growth stocks in the coming months.
Well, I guess I don't have a specific view in terms of which is going to outperform. I think it's too difficult to make a prediction like that. But I do think there is something very, very interesting about when people talk about value stocks, they talk about growth stocks. They assume that these are two very, very different pools of stocks, and that a value stock today looks a lot like a value stock in 1980 or 1975 or 1995. And I think what's missing in those categorizations is how much the markets change over time and how much companies change over time. A lot of the original idea of value investing, and Seth got into business in 1982, but going back to people who were there before him, like, obviously most famously Warren Buffett, that was a world where there just weren't a lot of people looking at what was a typical value stock. And a typical value stock didn't have much Wall Street coverage. It was a boring industry run by a board that most likely, was part of the country club set of the CEO. They didn't think about concepts like return on invested capital. There were just a lot of companies out there that were undermanaged, but the problem was, it was really, really hard to analyze them. I mean, even getting information on these companies was hard. You'd have to call the companies, they'd have to mail you the information. You didn't have computers, so you're doing a lot of the stuff by hand. When people talk about Warren Buffett spending 12 hours a day in his attic office reading annual reports, like it takes that kind of a mentality to dig in and find these gems. But you could find real gems. The problem is by the time I joined Balpos in 1994, the gems were gone. The LBO wave, the M&A wave, all the low-hanging fruit that had made a lot of value investors into legends during that period of time were gone. And so I think when people use those categories, I think they often miss how much the categories of the underlying companies themselves change over time. And so, but I think as a general matter, I think you're always better off paying less for something than paying more. And just the question is what you're buying for less more attractive on a risk-adjusted basis or not? Excuse me. I think there's been a big readjustment from the crazy spreads of growth versus value of a few years ago. I think people who've looked at this for a long time think there's still a long way to go. I don't feel quite as strongly about that because of some of the changes in the underlying companies that I think changes the calculus.
So let's talk about China now, because I saw that you also founded Apex Capital Management, and this is a hedge fund which was focused on the greater China region. And this had about 1.5 billion in assets prior to the financial crisis. And China is really, really interesting now. Many believe that Chinese stocks have become uninvestable because of this continued zero COVID tolerance policy and crackdown on their tech giants. In fact, the China Tech ETF is down more than 40% this year. So do you still look at Chinese stocks, and what are your thoughts on China now?
So I don't. I mean, I don't spend any time picking stocks. I would say my observation about China is, again, so I started a hedge fund with guys who were based in Hong Kong, and we launched in 2004. And what was interesting was that when we launched, there was a belief that China was going to basically become much more like the United States economically. And the precedent that you had at that time was what had happened with Russia. And Russia, in a lot of ways, the privatization was viewed as this somewhat of a failed experiment. There was a lot of, obviously, theft and misappropriation. But there was a belief that China was really going to adopt a lot of this, a lot of the more open economic policies that you saw in the U.S. But even by the late 2000s, the view had shifted, at least from the guys that I worked with, that it wasn't about China becoming more like the U.S. It was rather about China charting its own path, and that China is almost like what we had Manifest Destiny in the U.S. about, this they were going to create a new kind of world order, a new kind of economic program around a different set of values. And I think what's happened, I think there has been this kind of gradual bifurcation of that they've veered farther and farther away. And from what I understand with people who've done a lot of business in China, is there are still really, really hard challenges in terms of things like the rule of law. That I would get told stories by people who had businesses and, that were run by partners that they had in China. They would show up and the business was gone, and they'd walk 3 blocks to the left and somebody had just rebuilt the business there. So I think there's an enormous challenge for people who are on the outside trying to figure out what drives the behavior and the performance of Chinese companies. And I suspect, based upon what I see from hedge funds who've been invested very, very actively in this space, is that there's always this tension between great promise, a huge market, tremendous resources, and the struggle as to what will, how will government and policy impact that, and how much will it impair it? And I just don't think anybody knows the answer. That's why you have these two widely divergent camps. It's either, the opportunity of a lifetime, or it's uninvestable and forget it.
So that was about your past. Now let's talk about what you have been doing recently. And we mentioned hedge fund-like strategies in liquid, cost-efficient, and transparent wrappers. These are also referred to as liquid alts. So could you explain what exactly liquid alts are? What are they designed to do?
So liquid alts are basically when people take strategies, investment strategies that historically have been in hedge funds, and hedge funds have a lot more flexibility in what they do. When you do something in a mutual fund, there are a lot more limits in terms of exactly how you can invest. But the idea was basically to take hedge fund strategies and then to recreate them or put them into mutual funds or ETFs. And because of that, most investors, 99.9% of investors, cannot invest directly in hedge funds because you have certain net worth requirements, you have certain accreditation standards, et cetera. So the idea was, we've got these strategies that institutions love. We're going to put them into mutual funds or ETFs and then basically make them available to the other 99.9%. So the simple definition of liquid alts are, liquid refers to a mutual fund or an ETF with daily liquidity, and then alts just means something that's a different strategy than what you can get with your Vanguard 60/40 portfolio.
So managed futures, and you have an ETF that invests in managed futures. Managed futures, they are a form of liquid alt strategies. So could you explain what exactly are managed futures and what are they designed to do?
So managed futures is a subset of the hedge fund industry. And the strategies are based on the idea that most of the people in the markets are emotional. We have trouble changing our minds. We pile into things at the wrong time. And so what they are basically computer-driven strategies that analyze recent movements in stocks, bonds, interest rates, commodities, currencies, and try to figure out what is that? Is that telling us that if the dollar is going up, it's going to keep going up? If interest rates are going up, they're going to keep going up. If equities are going down, are they going to keep going down? And so some people refer to them as trend following. But basically, the reason it's called managed futures is because these guys have computer models that change what they do, because a good trade today might not be such a good trade in a week or 2 weeks or a month. So the portfolios are constantly rotating. I mean, you think about somebody who's trying to decide how to make money tomorrow, not always looking in the rearview mirror saying what would have worked. And then futures contracts are just the investment weapon of choice, because if you want to bet that oil is going up, nobody wants to go out and buy barrels of oil and store them in their backyard. You have this incredibly world of derivatives where you can just simply buy exposure to it through something called a futures contract. It's extremely liquid, easy to get in and out of, and you can just as easily bet it's going to go up or go down. So it's a 40 or 50-year-old strategy that is run by guys who, it's a complicated strategy run by guys who run these computer models and are constantly buying and selling different things. And so why it's valuable and why we went down that path is a different question, but that's the idea of how the strategy works.
So let's talk about your ETF now, the Managed Futures ETF. It is DBI, Managed Futures Strategy ETF. And as I mentioned earlier, this is up more than 30% this year and has seen a lot of interest from investors. It now has over $1 billion in assets, of which more than $960 million came in this year, which makes it one of the fastest growing ETF this year. So tell us, what exactly does this ETF intend to do? So you mentioned trend following. So how exactly you follow those fast moving trends? Do you try to replicate those trends? Do you look at 13F filings? Tell us a bit more about this ETF.
So let me take a step back and tell you, first of all, why we liked this as a space. Because as you know from my description of the background, I was not going to engineering schools and programming, and so I'm a value investor who fell in love with a strategy that is almost the opposite of value investing. And the reason I fell in love with the strategy is because you can look at it in isolation, or you can look at it in the context of stocks and bonds. And I'm a believer that stocks and bonds, over long periods of time, they've been incredible assets, right? And so 99.9% of investors are going to start with some combination of stocks and bonds around their risk tolerance. What managed futures does is that it tends to do the best in the worst periods of time for stocks usually, but sometimes, like this year, bonds as well. And so, we often say that it hit the trifecta in that it made really, really big returns, 40% or more returns back in 2000 through 2002, and 25% or more returns in 2008. And then broadly, the space is up well into the 30s this year. And so in a sense, it's almost like an insurance policy that you can put into a portfolio of stocks and bonds to protect yourself in a year like this. And again, having been in this business for a long time, you're often trying to find things that can help your portfolio at the time when you need it the most. And so we viewed it as a way of basically buying flood insurance before the flood. And if we structured it the right way, instead of paying a lot of money every year for flood insurance, we would get paid to own it. And so with those diversification benefits in mind, we built a strategy back in the middle of 2016 where we said, there are different ways that we could try to get access to the strategy. We could go out and put money with actual hedge funds, but we need a lot of money that's illiquid. They charge really, really high fees. That's not really a great idea. There are some very, very good mutual funds out there that do this. Well, we could put money with them, except honestly, we have had no idea which of the mutual funds would do well. And when they did badly, they tended to do really, really, really badly. We could build our own product and hire a bunch of hedge fund managers to do it. But again, it's very, very expensive. So we were looking at all these different ways of basically with this idea of, we love this strategy, we want to get exposure to it, but we want to get exposure to it in a different way. And the different way is that we wanted to get exposure to, as though we were invested with a lot of different guys in the space. Because when you invest in this space, everybody has a very, very different flavor of how they approach it. So the analogy that I've used, it's as if you said, I want to invest in emerging markets, but I'm only going to pick Brazil or China or India or any other country in the emerging markets index. And we didn't want that. We wanted the whole index, right? We wanted, because we knew this year, despite what you hear, Brazil's stock market is actually doing really well. China's doing very poorly. Next year, it may flip. And the other thing we wanted was to cut out as much as we could in fees and expenses, very much in the Vanguard model, that if you reduce your fees and expenses relative to a high cost product, you tend to do a lot better over time. A lot. And in hedge funds, when you cut out a lot of fees and expenses, you do much, much better over time. So what we tried to build was an ETF, the ticker of which is DBMF, that basically is your one-stop solution. So you have stocks and bonds already. But when you run an asset allocation model, you say, God, I really wish I'd had managed futures this year, and I better put it in my portfolio now. So I want to make it 5% of my portfolio or 10% of my portfolio. DBMF is designed just like an S&P 500 ETF for you to be able to basically just use that as your allocation. And it's in an ETF. It's got an 85 basis point expense ratio, so it can fit seamlessly into your portfolio. That was our whole business idea of DBMF and what we're trying to bring to the broader ETF world today.
So let's talk about how this ETF became so successful this year. What exactly did it hold that resulted in this 30% plus performance, and what does it currently hold?
The reason managed futures funds do so well in a year like this is because we're in the middle of a big regime shift. And in a regime shift, human analysts have a very, very hard time envisioning how far things can go from where they were and what we were used to. So inflation, by the early 2021, inflation was, people thought inflation would never come back. And we start to see signs of it. So what you saw in these portfolios, and again, it wasn't us. So the way that we approach this space is basically to say, we can figure out what the biggest guys in the space are doing, the legends who've been doing this for a very, very long period of time. We can't figure out exactly what positions they hold in every single market, but we can figure out their big trades. Are they shifting from a view that rates would keep going down to one that rates would start rising? And so the big trade in managed futures this year has been, if you had to boil it down to a single word, it's inflation. And inflation has been rippling through markets. At one point, it was rippling through the commodity markets, and oil was going up. Well, the hedge funds that we look at were long oil, so we were long oil. And as treasuries started to go up more and more, the guys that we were looking at were short treasuries, so we were short treasuries. And we doing this through futures contracts. And then over the past several months, a lot of it has been about the strength of the dollar. That the dollar has just marched. I mean, if anybody's traveled abroad recently, everything is incredibly cheap relative to where it was a couple of years ago. And so in a sense, the underlying hedge funds themselves are having a phenomenal year. They're up before fees somewhere in the low to mid 30s. And what we've essentially been able to do is copy their biggest positions and be up a similar amount. The big difference is if you invested in one of these hedge funds this year, you're paying 800 basis points or more in fees, whereas in an ETF, you're only paying 85 basis points. So we're very much in the Vanguard ethos of, if you want to consistently outperform over time, you drive down your expenses and costs as much as you can, again, without diluting the returns of the underlying product, and you'll consistently outperform.
So you mentioned the surge in the dollar, and that is one of the biggest stories in the market this year, in particular against the yen, because the Bank of Japan continues its easy monetary policies. So the yen is at its about 32 years lows against the dollar. That is a very interesting trend. So in your view, what trends are likely to do well in the coming months? Do you have any thoughts on that?
Not really. So I think my general macro view, which is a little bit more vague than a specific trade, is that the 2010s, I think we'll look back on the 2010s as this very, very, very strange, very extreme period. And we went through a period where somebody quoted the figure that there was $40 trillion of central bank bond buying and spending by fiscal governments. And we did this for a decade and didn't generate extremely high growth despite spending all that money, and then also didn't have inflation. But now it's sort of come back, and so we have very indebted governments. We have a fragmentation of the geopolitical world order. We have supply chain disruptions. We have a reversal of decades of globalization. Now seems to be deglobalization. We have war and God knows what's going to happen in Europe this winter. I mean, we have all these very, very serious issues, and as the Fed keeps raising rates, it's rippling through markets, and we haven't had that big Lehman moment or Enron moment, where things start to collapse. But it feels like the cracks are spreading. So I mean, I think our general view is that the macroeconomic environment is going to continue to be very, very, very challenging, and it's not going to take 9 months for this to be resolved. This is going to happen over multiple years, and during that period of time, you're going to have brief periods of relative euphoria, like you had in October in the equity markets. And you'll have reversals. You'll have all sorts of volatility. But the big question is, starting from today, and you look at a standard portfolio of stocks and bonds, is that going to deliver 5% per annum to you over the next 10 years, or is it going to deliver 2% or 1%? I don't think anybody knows the answer, but I think that's the big question from the perspective of a typical investor, is to where am I going to make money, and what if it does get worse from here?
Now let's talk about your other ETF, which kind of tracks the performance of long-short equity hedge fund strategies. Tell us about this ETF, and this has also done quite well, though not as much as your futures strategy ETF. So this is down about 5% year to date, which is much better than the broader index's performance.
So we do the same thing. Again, what we're trying to create for an ETF allocator is, and so again, they're very different. Managed futures as a strategy is a true diversifier, right? Equity markets and bond markets both go into horrible bear markets this year. The strategy goes up, loves a market like this. If we enter into a period of time where equity markets are, consistently going up, you would expect managed futures to underperform. But if you structure it right, won't underperform by much. Equity long short is a different idea, in that it's basically the view that when most people invest in equities, they do it, they don't change what they do very much. So if you have 2/3 of your portfolios in the S&P 500, and you've got a little bit here and a little bit of emerging markets, you basically have these core allocations, but sometimes those aren't the right allocations to have. In the 2010s, if you had most of your portfolio in the S&P 500, you could do no wrong, right? The S&P 500 did so much better than non-US developed market stocks, so much better than much better than emerging markets, better than small cap stocks. So the easy trade was the one that worked in the 2010s. My guess is, given how extreme things got in the 2000s, in the 2010s, that this decade will be very different. So if the great opportunity a year from now is in emerging markets, because China, as you say, is not uninvestable anymore, but now it's the great alpha trade of the equity markets of the next 5 years. What equity long short hedge funds have so much more flexibility to do is to change how they invest, to shift, to go from being way overweight FANG stocks a few years ago to, if the great opportunities in industrial stocks in China, they can pivot and move into it. So what we do is the same philosophy here. We're not stock pickers. We don't go out and tell you exactly which of these funds is going to be the best, but rather we think there are a lot of guys who run these funds who collectively have decades and decades of experience. They're super smart. They have incredible resources. They have all of their own money sitting in their own funds, so they're completely aligned. And they're going to find really, really interesting ways to make money. But again, with the idea that if equity markets go up 5 or 7 a year for the next 5 years, and these guys can do 5%, they can match the performance, but with half the risk. It's just a really, really good thing to have in your portfolio. And so the second ETF is, the ticker is DBEH. What that's really designed to do is for you to say, I'm a little concerned that the equity market's going to go down a lot from here. I just don't know what it's going to be like. We could have another Lehman moment. This is a way for me to actually dial back a little bit of my risk. But as the world keeps changing, these guys may find ways to make money in the same way that maybe a particular stock picker might be able to. But in this case, it's by moving among the right markets at the right time. So, we really think about these two as these are building blocks for people, for their portfolios. decide you want managed futures, you have an easy solution here. Decide you want equity long short, you have an easy solution. And and with the right tool in their hands, allocators can make their portfolios a lot better.
So you mentioned how you want investors to look at these strategies. Can we talk a little bit more about how these strategies fit in an investor's portfolio and how exactly investors are using these strategies in their portfolios as of now? Are they using these strategies mainly for diversification purpose or for alpha generation? And then could you also talk about any risks that investors should be aware of?
I think everybody's comes at it a little bit differently. I think DBMF is the managed futures product is relatively straightforward in that if you had a portfolio, something that looks like a 60-40 portfolio, and it worked every year during the 2010s. As interest rates were coming down, your bond portfolio just kept going up and going up. Your stock market, we had certain bumps along the way, but stocks kept going up every year. It was an extraordinary decade for 60-40 portfolios. Managed futures is, I think, the most valuable diversifier to put alongside that portfolio. So I've been hitting this drumbeat of, it used to be stocks and bonds, and it was stocks and bonds in real estate, or stocks and bonds in commodities, or stocks and bonds in gold, or it was always stocks and bonds plus something. I think in 2023, because here you have a strategy that was up, it was up 30% plus through the first 9 months of the year during this grueling bear market. I think the refrain next year is going to be stocks, bonds, and managed futures. And the only question is going to be: do I put 5% into it? Do I take it all from bonds? Do I take it all from stocks? Do I put 10% into it and take a little bit from each side? So I think managed futures is very, very straightforward. Equity long short, as I mentioned, is really it sits alongside your equity allocation, and the idea is that it's just it's essentially almost like a global, flexible asset allocation strategy alongside your equity allocation. Where in a year like this, a typical stock picker can only go out and pick stocks. But part of the reason the fund has protected capital this year is because you had guys who were picking stocks who then started also on the hedge fund side, they started to shift into value stocks. But then they also put on interest rate hedges. And so when we saw that, and we saw that they were doing it and we did the same thing, it ended up protecting capital this year. So I think when you look at that fund since inception relative to equities, it's very, very impressive from a risk-return perspective because you've had less than half the risk, but comparable returns.
Excellent stuff. That's all we have time for today. Andrew, thank you so much for joining us and for sharing your excellent insights. And congratulations on the success of your strategies in a very challenging year for the market.
Thank you so much. I appreciate you having me on today.
So that was Andrew Beer of Dynamic Beta Investments. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@sachs.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.